Welcome, dear traders. In the Asia-Pacific region, trading started with a cautious market sentiment. Stock and currency markets are digesting the FOMC meeting minutes issued yesterday. Japan continues to assess the consequences of the devastating earthquake and the plane crash at the Tokyo Haneda Airport. Recent economic reports from China have also provided traders with the issues to think about. Those who had expected a sharp and early cut of the key rate by the Federal Reserve were disappointed by the recent FOMC meeting minutes. The protocol failed to provide hints about the timing of the first key rate cut. On the contrary, it confirmed the previous Fed statements. In other words, most politicians intend to keep high rates for a longer period. According to the FEDWATCH tool, markets see the likelihood of the Fed rate cut in March at 66.5%. Notably, 6% of respondents assume a half-point contraction at once. Only 27.5% expect the regulator to maintain its current stance. And yesterday, this ratio was 8.70 and 22%. As you can see, the two-week-old document has almost no effect on the New Year's optimism in the stock market. Nevertheless, just a slight decline in expectations of an early rate cut by the US Fed Reserve was enough for the dollar to lose its upward momentum and launch a correction. Today, the US dollar retreated from the levels it reached in the early days of the new year. For example, against the basket of six main currencies, the greenback rose to a three-week high of around 170 points yesterday. However, the publication of the Fed's minutes as well as the data on the job openings and manufacturing PMI changed the situation. The data confirmed the cooling of the labor market and a decrease in manufacturing prices by 4.7%. In addition, FOMC member Thomas Barkin said on Wednesday that the expected soft landing was increasingly possible. Therefore, the market prefers to wait for the key report, which is a Non-Farm Payrolls for December. The data is slated for release tomorrow, and today the US dollar index continues to decline moderately, consolidating in a narrow range of 102.20 and 102.5. In the case of a new bullish rebound, it can test the technical resistance at around 102.60 points. Support levels are located at 101.70 and 170 points. The Japanese yen also consolidated after the US dollar. As we can see on the trading chart, the pair has been rising since the onset of the year, and the US dollar managed to reach almost a two-week high against the yen on a Wednesday, marking the best performance since October. Early on Thursday, the yen increased within the range of 142.80 and 143.90. However, during the Asian session, the pair's movement was determined by the greenback's appreciation. The yen was trading below 143.50 amid the dollar's consolidation. However, the overall bullish impulse may push the price to a technical resistance level of 144.70, and the first support level is seen at 142. The publication of a Japanese manufacturing PMI also exerted pressure on the yen. The indicator showed the sharpest drop to 47.9 points since February. What's more, sales in the foreign market slumped more than in the recent 6 months amid a smaller number of orders from the main export markets, namely China, Europe, and North America. Today, Bank of Japan Governor Kazuo Ueda also commented on the future actions of the central bank. He hopes that the salary growth and inflation will reach a balance. Although some traders still believe that the Bank of Japan will switch to a more aggressive approach. At the upcoming meeting scheduled for January 22 and 23, the regulator will hardly announce any changes. This could be mainly explained by gloomier market sentiment and the yen's depreciation amid the powerful earthquake that took place in the western part of the country early this week. The Australian dollar was also trading downward during the recent 24 hours after its New Year's cross. Earlier today, it attempted to consolidate near the upper limit of the range of 0.6710 and 6760 amid fresh macroeconomic reports from China According to the data, business activity in the world's second largest economy advanced at the fastest pace in December compared to the previous 5 months. What's more, during the Asian trade, the Australian dollar benefited from the greenback's correction and resurged in commodity prices caused by geopolitical tension. From a technical point of view, the Aussie dollar pair is under bearish pressure. That's why it may approach the nearest support level over 67 cents. The resistance levels are located at 0.6770 and 0.6870. The New Zealand dollar is also often used as an indicator of a risk sentiment in the currency market, and today it was hovering near two-week low. The intraday range of 0.6230 and 0.6290 may remove its downward to the technical level of 0.6220 amid the overall bearish impulse. If the risk sentiment increases, the New Zealand dollar may test the resistance area of 0.6290 and 0.6360. To get up-to-date information, you can also watch our next video reviews. The recap of the trading in the Asia-Pacific region on January 4 has come to an end. If you have any questions or comments, leave them under this video. InstaForex TV experts will promptly answer them. So, see you online later.